What's going on, Mr. Jacob?
How you doing?
Good, buddy. How are you?
Good.
Barely hear you, by the way. There we go. Turn you up.
Yeah, I'm driving right now, so that might be why.
Nice.
I got some questions for you at 3:30, but I don't know if you'd be able to answer them for me.
Okay. Well, we got a couple seconds now. What do you got?
It's about taxes for real estate agents. I just wanted to know what I should, like, what receipts I should keep and stuff for taxes.
Yeah, I will not answer that question for you, but I will direct you into the name of someone who can help you.
She's gonna charge me?
I don't know what she's going to do.
All
It's worth a call to her.
Yeah.
She didn't charge me when I started.
All right.
So. Jacob. All right, cool. Should have it. Lead coming to you now. Hey, Adriana, did you get those things sent out?
Yes, sir. Feeling so proud of myself.
That a girl.
Thank you.
The simple adjustment, huh? Is all it was.
And I took my husband is off today, and I might got another lead. We took her for a walk to the park, and we met an old contractor of ours, and he's looking to buy his third house. So maybe.
There you go. It's all about starting somewhere.
I know. Not as easy as I thought, but
All of this is just a process. I hate that everyone shows up late. Come on now. Where is everybody?
It's President's Day, so I don't know if people are off.
President's Day is not a real holiday. President's Day is a fake holiday. Right, Steve? You're muted.
Well, why'd you mute me? Yeah, President's Day is a fake holiday. It's one of the busiest days of the year for us.
What does it make? What makes it a busy day for you guys?
Because most employees are off of work and they call us like crazy. So when people are off of work, it's finance time. So they're like, okay, I'm going to handle everything on Monday on my day off.
Can I get my tax information from last year?
Right, exactly.
Yeah, so, gotta love it. So we're slowly rolling into this. We were just talking about, it's like, where the heck is everyone? But then Adriana was like, it's President's Day. I don't care.
Yep.
Maybe I have unrealistic expectations of my work schedule. But I got one text from one person. Where is everybody? There's Devlin joining the call. I know Devlin needs this information for loans. He's getting back into it, so Devlin needs to have the excellence that is FHA informations. Got Scott Anderson joining the call. Scott Anderson definitely needs some information about some FHA loans. Good to see you. Love that your cameras are on too. Teresa Zizak, nice to see your face. Oh wait, I can't. Charity, same thing. The big black screens of death.
Hey, I have been running nonstop and I'm exhausted and I look very haggard. So I'm doing you a favor by keeping it off.
You're still prettier than I am. It's okay. When do you close that deal with the terrible AB?
I extended it to next Tuesday and sent an amendment an addendum, I'm sorry, and I think I copied you on it. She hasn't sent it back yet, but I did text her politely and she said she would send it to her clients. So we're being all happy and nice.
There we go. Miss Charity, how are you today? You dyed your hair, it looks like. Very nice.
Yep, got to get it redone.
You don't want to be a
Doing
redhead?
good. Huh?
You don't want to be a redhead?
Oh no, it didn't stick all the way.
Oh, okay.
So just gotta do it again. I should have known, like, going red is harder. So
Life is
yeah.
tough for a ginger, right, Devlin?
But yeah, I had a buyer's consultation about an hour ago. So that was good.
That's awesome. Well, guys, as people get logged in here, 2:34, we're coming up on 2:35, so I'll give that 5-minute grace period for people to jump in. Today is Mortgage Monday with Steve Lemons. He's coming on today. We're going to talk about the intricacies, whatever that word is, intricacies of FHA loans. What is it? Intricacies. Thank you, Jason.
Intricacies.
Intricacies. You guys know that that's the word I struggle with. Intricacies of FHA loans and how we can utilize the programs available to us, understanding the loan type and what type of house to put them on, and getting you guys some tips on how to win more contracts right now. So understanding all that, give your attention, Mr. Lemons. We're going to hand the floor to him. So you got questions, let's bring them up at the end. Make sure that we kind of follow along and get some insight information because, thank you for your time, Mr. Steve. We appreciate your knowledge and insight. But beyond long, man, it's all yours.
All right. So what I'll do first, guys, is I'm going to give you just a brief overview of how an FHA loan works. I'll talk about some of the pluses and minuses of it, and then I'll talk a little bit about how it affects offers, contracts, things like that inside of a transaction. So the first thing that you should know about an FHA loan, and it's a common item that is misconstrued about them, it is not a first-time homebuyer program. Although first-time homebuyers use it a lot, FHA actually stands for not anything to do with first-time homebuyers. It just has to do with Federal Housing Administration, and it's administered by the Department of HUD. So the good things about FHA loans is they allow for very little down, as little down as 3.5% for a regular FHA loan that doesn't have a grant or any kind of down payment assistance alongside it. The other thing to know on it is that it allows for relaxed credit guidelines. What that means to you in English is people with lower credit scores have a better chance of getting an FHA loan than they would in a conventional loan. So it is a very, very good loan for people who are in the 600 to 680 credit score range because they can sometimes get better rates and pricing on an FHA loan than they can on a conventional loan. On an FHA loan, just know that for all intents and purposes, most lenders in town will go to 600 or 620 as a minimum credit score. And anything below 600, there are actually some lenders out there that still may entertain it. I don't know any in town that do, but you can actually do a credit score below 600 on an FHA loan, but you have to have a minimum of 10% down. So when you're going above 600 and you're going to your minimum down, the one thing to know about FHA loans that's very important and is considered a negative to FHA loans versus conventional if you were comparing them apples to apples. An FHA loan has two forms of mortgage insurance. The first form of mortgage insurance is called upfront MIP. And that percentage is set by the federal government, and that is 1.75% of the base loan amount. And that amount of 1.75%, whatever that figure is added to the loan. So as an example, if you have a $200,000 purchase price at 3.5% down, your base loan amount would be $193,000. Then you need to take that $193,000 times 101.75. And then that's going to come up with your final loan amount of $196,377. This is very important from a contract perspective, because when you get the pre-quals from lenders, the pre-qualified loan amount is going to include that FHA mortgage insurance. But remember, on every FHA loan, unless it's a HUD 184 program, which is a special program that is rarely done in Tucson, or the neighbors program, it's always going to be 3.5% down. So your contract should always represent the 3.5% down calculation, not the down payment based on the final loan amount. I will let you know the first time you do it, you know it's going to come up and it'll be a big deal, because your contract is going to show the buyer having to come in with like 2.5% down or 2% down, versus our disclosures that would show 3.5% down. And it becomes a little bit of a bone of contention for clients. So just make sure that your offers, when you're doing an FHA offer, they are structured at 3.5% down. Now, on FHA loans, they do allow down payment assistance or grants through the county. A lot of people ask the question that when they're drafting a contract, should they put the loan amount to be the same as the sales price if they're getting a grant to make it 100% financing? The answer is no. The down payment should still be referenced as 3.5% down, and that 3.5% down should be coming from the Pima Tucson Homebuyer Solutions grant. But the base loan amount should always be based on the contract at 3.5% down. Any questions on that? Okay. So
got some note takers that are shaking heads, so I know that you're touching some heads here. You guys have any questions at all on what he's talking about? The grant, FHA down payment needs. It is not a first-time home buyers program. Good?
All right. Now, the second form of mortgage insurance on an FHA loan, huge difference other than the upfront. So the upfront does not occur on conventional loans at all. So there is no upfront mortgage insurance at all. The second form of mortgage insurance is the monthly MIP. And one note for everyone here, because in the industry, most real estate agents just refer to mortgage insurance as PMI. PMI is mortgage insurance for conventional loans. Mortgage insurance for FHA loans is referred to as MIP because they like to be different. They call it mortgage insurance premium versus PMI, which is private mortgage insurance. So the monthly mortgage insurance on an FHA loan, when you're putting less than 5% down, is 0.85% monthly. So again, let's just say we have that calculation on the $200,000 purchase price at 3.5% down, and then we add in our funding fee. So then we can then calculate the monthly mortgage insurance premium, and all you do is take your final loan amount times 0.85%, and you divide that number by 12, and then you come up with your monthly amount of, on this scenario, it'd be $138 a month. So the calculation isn't important to you guys. It's just knowing that there's two types of mortgage insurance on there. I will caution any real estate agent, when you start getting into numbers, financial numbers in the mortgage side of things, you're delving into a place where your license doesn't protect you. So you want to be very, very careful about going too far in terms of questions and answers on that, because if you're wrong, it can really, really mess up the transaction and create some awful expectations for your buyers and sellers. Now, the most important part to know about FHA loans is, unlike a conventional loan, the mortgage insurance, once you get it, it is permanent. In other words, it never goes away unless you put 10% or more down. When you put 10% or more down, it goes away at a whopping 11 years. Yep, let me give you that date again. It's 11 years that it's going to be on the loan. So I'm just going to do a simple calculation off this $138 times 11 years, which is 132 months. It's $18,000 of mortgage insurance on that loan in the first 11 years. We're on a conventional loan. Once your loan to value gets to 78% of the original purchase price, your mortgage insurance automatically drops off by law, assuming that you're current on the mortgage and that you're still living it as your primary residence. So that is a major difference. So anytime you hear a lender saying that, oh, my client's going FHA because they're getting better terms, what that should mean to you is that one of two things, and it's always requires more questions. One, I would ask that lender, why are they getting better terms on FHA? And their answer should really be primarily because of the fact that they needed it for credit purposes or their credit score was lower. If they just say, I'm going FHA because they get better interest rates versus a conventional loan and they have perfect credit, that is a sign of a lender that does not know what they are doing. And I mean that without a doubt. There is no financial argument that you can make if you have a borrower with a 740 credit score that they would ever go FHA over conventional, because it's a more expensive loan. So because the mortgage insurance on a conventional loan at 3% down with perfect credit is about 0.54% versus 0.85%. Now, the interest rate is slightly lower on FHA loans, but again, the fact that the mortgage insurance is permanent makes the loan very expensive, and not to mention they still have to pay the 1.75% upfront. So those are some of the general characteristics of an FHA loan. There are 30-year FHA loans, there are 15-year fixed FHA loans, and there are adjustable rate FHA loans. But most, if not all, I think in 25 years of doing this, I've probably done one 15-year fixed FHA loan. And it is normally the buyer who is putting a ton of money down, but they had a foreclosure in the last 7 years. And the only way they can qualify is FHA, because conventional does not allow any foreclosures in the last 7 years, where FHA will allow a foreclosure with as little as 3 years and a bankruptcy as little as 2 years out. So those are very important characteristics to know about FHA loans. And you can see that they have a lot easier credit guidelines to deal with. That's why they allow people to get in after a significant derogatory event like a bankruptcy or a foreclosure quicker than they do on a conventional loan. Because the conventional loans, even though they sound like they are government loans, they're actually not government loans. They are backed by a government agency. And those agencies are Fannie Mae and Freddie Mac, but they still are private investors that invest in those loans. It's not the federal government backing those loans. So that is the reason why you get slightly lower rates, but the mortgage insurance is there to basically, even though the government goes back and forth in the reasoning behind it, the reason why the mortgage insurance is there and is so costly, it's there to risk against defaults from the loan type in general. So the government covers all of those delinquencies and foreclosures, and they get paid out of that fund that the mortgage insurance is collected into. So that's why it's not, you won't see it going away. And they are talking about potentially reducing the mortgage insurance premiums on FHA loan because they're performing so well right now. But for anyone who's heard about FHA loans in the past, just know that they've done this once before, and then they raised it right back up when defaults went back up. So it does ebb and flow with the market conditions, but right now most FHA loans are performing very well, so they're not worried about that. So they're talking about reducing the mortgage insurance a little bit this year. Any questions on any of the program stuff there? Okay. Some other things to know when you're adding a grant behind it, especially the Pima Tucson Homebuyer Solution, otherwise known as PTHS, is what it's commonly referred to in Pima County. Whenever you add a Pima Tucson Homebuyer Solution grant behind it, there's an additional overlay that is put in place on the property itself. For them to refinance or sell that home, in the first 3 years, they will have to pay back all or a portion or a prorated portion of the grant that they were given. It's not a prepayment penalty because they can pay it off at any time, but they have to pay back the grant if they don't fully execute the grant, which is a 3-year time frame for the grant. A lot of people are not aware of this until they get to the closing table. So it's a very good thing to know up front. If somebody says that they're looking for down payment assistance, you can say, you can actually Google it. You guys have access to the website as well. And I can send it to Dan to forward to all you guys. But it'll go through the rates of the program. It will go through the guidelines. It will go through the income limits, all of those things. The one really cool thing about the FHA down payment assistance program, because it's government backed and not privately backed, the income limit for a FHA loan today, I'll actually pull it up here real quick and I'll give it to you here. The income limit for FHA loans, USDA loans, or VA loans is 109,065. So it's a lot of income. As opposed to the conventional version of that loan for the down payment assistance program, for the reduced rates on the conventional loan, the income limit is $54,720. So it's literally almost double that on an FHA loan. So say you get a buyer who doesn't have a lot for down payment, but they have really good credit, but they want to do zero down and they make $95,000 a year. We would use this FHA grant program to get them in at zero down because they're under the income limits. So it is a very good tool, especially for the buyer that makes a decent amount of money, but doesn't have a lot for down payment. This is a good option for them. The other thing that this program is used for is very simply this, especially in today's market. I use it a lot right now. We're actually using it on Huerta, which is one of your deals, I think, with you and Robin, Dan.
Yep.
So Huerta, I'll use this and I'll just use his name so I could just use it as an example. He has his down payment, but we couldn't negotiate closing costs in the transaction. So instead of him freaking out and going, oh my gosh, I got to cancel, what I did was I took him from a regular conventional 3% down loan to I took him over to the grant program because he's under the income limit, and I'm able to get him a 3% grant to cover his closing costs. So even though he doesn't need the grant for his down payment, he did need it for his closing costs. So we're going to add that grant onto him, and he gets to go in and buy his home and not have to worry about begging, borrowing, and stealing the money for the closing costs. The only thing that is different between a regular FHA loan and the grant FHA loan, other than the 3-year period, is the grant FHA loan. When you go through Pima County, there's a 1% origination fee on it, which is 1% of your loan amount, where on a regular FHA loan, they are normally offered at 0 points or very little points. So we don't necessarily have to charge that fee on a regular FHA loan versus the grant program.
So
the only
anyone, yeah, go ahead. I'm gonna anchor a point on that one. Anyone had a,
go ahead, Dan.
Client had the money for the down payment. They knew they had 3% or 3.5% down, but had no idea about the closing costs. Anyone run into that? Right. So buyers out there think that, you know, I've got my 3.5% down and get an FHA loan, and then they come to find out that there's an additional $4,500, $5,500 worth of closing costs needed, 2.5%, 3%. That are out there. So this is one of those things that in the market right now, are you able to offer enough on a house to get closing costs accepted? No. If you got closing costs, a death sentence, right? You guys can see how utilizing this system that Steve's talking about allows us to have extra ammunition if they qualify. So working with a professional like Steve and his team, giving us those extra opportunities, the extra ammunition for this deal, may take a buyer that otherwise would not have a chance in hell in this market right now and give them a leg up. If you got the money for their down payment, but they don't have the closing costs, don't worry. These are conversations you can have. So I want you to keep this in mind when you guys are working with your buyers, that do not think that there is no chance. Communicate with your lending professionals and ask these questions so you can be in line with the programs that are designed to help us help our buyers out even more. So little plug, that's all.
Absolutely. And the other thing to know, guys, about this program is a lot of listing agents get really concerned because they see a grant. and whether or not it's going to be funded or not. The one thing to know about this particular grant program is all the preferred lenders actually fund this loan on their own. It's perpetual. In other words, it doesn't go away. So this is an automatic program that's in place for Pima County. So just keep that in mind, guys, that it's not something that's going to mess with your contract or your offer for sure. Now, when you're getting into an FHA offer, how many people, when they're doing an FHA offer right now, are getting a lot of pushback that they don't want to take an FHA offer on the home because they're worried about it, you know, not appraising or whatever? Does that come up to anyone? All right, so I will let you guys know, you may not have felt that yet. It will come up when you put in offers. Couple of things to know about FHA loans versus conventional loans, VA loans. First thing to know is that all the appraisers that do FHA loans also do conventional loans. So it's the same appraiser for both, which means the value is normally going to be very, very consistent no matter which way they go. Here's the primary things that are different. An FHA loan, for one thing, requires all the utilities to be on and working inside of a house. A conventional loan does not. The only time a conventional loan requires them to be on is when lovely Mr. and Mrs. Seller or listing agent or buyer or buyer's agent goes, oh, appraiser, yeah, I don't know why, but the water doesn't even work at this house. That's a problem. But if it's just off on a conventional loan, they're not required to check it. Where on an FHA loan, it is required to be checked and operational. So you will notice there's going to be a lot more requests for things like repairs on an FHA loan or minimum property standards met. So the big key things that we see in Tucson, for the most part, very big list items here. HVACs are number one. Leaking swamp coolers. So if you walk onto a roof and there's a whole bunch of sediment up there and it looks like it's been leaking, that causes two potential issues: potential roof issues and also potential swamp cooler issues. So they're going to probably ask for that and call that out to be checked out. We're on a conventional loan, they may turn a blind eye. Also know that if it's a flat roof on an FHA loan, in theory, and we're seeing it come up more and more during COVID, all roofs are required to have a life expectancy of at least 2 years. That is not well known by the real estate industry, but I'm sure at one point, Dan, have you ever got an FHA loan where they came back asking for a roof inspection and a certification that the roof's good for 2 years?
Yes, we did on one of our properties last year, actually.
Yep. So that is an FHA requirement for a flat roof. On a pitched roof, they don't normally see it because it's shingles and composite, but on flat roofs, there's a definite guideline around that because of sediment and settling in the home and on the roof itself. The other thing that comes up a lot, and I do mean a lot, if you have a home, and it's an Arizona phenomenon that it's just pretty normal out here, is that if you have a property that has peeling paint, or it was built not prior to 1978 with peeling paint, huge hot topic for FHA. So they're going to pretty much require you to scrape and paint the fascia or whatever the area is on that. Now, I had one recently that it was a brick home and it was painted white, but all the white paint was also flaking off the brick. The appraiser literally called for 2 of the walls of the outside of the home to be repainted because it had so much peeling paint on it. So peeling paint is 2 things to an FHA loan. One, when your paint is peeling, it can allow for water intrusion and dry rot. 2 things that we don't like to see on a home. And number 2 is the obvious one. It shows that the home hasn't been taken care of very well, and they're basically asking for the deferred maintenance to be taken care of on the home, is the other reason. Now, when you get into weird situations on FHA loans, like some random repair, so another random repair that can come up on an FHA loan, pool equipment. On a conventional loan, your pool equipment, it's not working, you just have it off, no big deal, they don't check it, they don't care. On an FHA loan, if that pool equipment's not working, they're gonna require it to be operational because that's one of the mechanicals in the property. And in the contract should be a warrantable item. Because if you can get a warranty for it, that means that it is considered warrantable. So warrantable items are HVAC, refrigerator, washer, dryer, dishwasher, range, and microwave, and pool equipment. For example, say you have a water softener. A water softener not operational on an FHA loan, again, could come up because that is now become a mechanical and is a warrantable item that you can add to a home warranty to protect against it. So obviously things like the flooring, you can't add that to a home warranty because it's not mechanicals, but any of the warrantable items that can be placed into a home warranty can be called out on an FHA transaction. Some other things that come up that are very unique on FHA loans, and this primarily is we're going to delve into manufactured homes a little bit because manufactured and FHA are done a lot of the time. So on a manufactured home, just know that if you have a well share, it can be no more than 4 people on that well share. If it has 6, the answer is FHA will not do it. There's no exceptions. You don't need to go ask a lender. It is an absolute no. And I will speak for every lender across the country because I will let you know, you're going to get to that loan officer and they're going to be like, oh, I think we can request an exception on the number of well share. You can't get an exception on that. That is a hard guideline with FHA. The other thing to know about it is if you have a private well. If you have a private well, and this goes into addition to the shared well, we do need to make sure that the water is potable for drinking. So you do have to get a water test, and that test is normally done. I know for most people in town, you guys may have someone that you guys use there specifically, Dan, but I know most people use Turner Labs in town, and they can do water tests. I will let you know the reason why this is important on an FHA loan is this would be considered part of your inspection process. And you want to do it up front because the water test takes about 10 business days to get back. And what happens with a lot of lenders, and I'm going to say lenders, not agents, this is where lenders get lazy. Lenders know that you have a well, but they don't tell you about the well requirements until after the appraisal is in. And then all of a sudden you're scrambling in the end to get everything done. So the reason why this information is important to you is if you know you have a well and it's an FHA transaction, I would be going to whoever that lender is, us, anyone, and say, what are the requirements that we need to get on this well right away so that we don't have any delays in our transaction? Because it's weird that it happens, but I actually did have a deal last year in Benson where the well was producing some kind of mineral that was bad for humans to consume. And they couldn't get it cleared out. So in other words, the property had no water source. Had they not done that inspection up front and did it at closing, they would have probably ended up closing because it was still going to be able to go through because they switched to a conventional loan, which it wasn't a requirement anymore. They did start FHA though and got that and found out that there was no potable water in the home and ended up canceling the transaction. But water issues can come up, and if water needs to be treated, it does take some time, and there's very few resources in town that will do it. And Turner Labs does have people that can come out and actually do some of that, but it does take some time. So it's always better to make sure that you do this up front as part of your inspection process versus doing it in the end when the lender asks for it. Because keep in mind that lenders a lot of times don't necessarily, I know I'm going to say this out loud, but they don't necessarily know the guidelines for wells. They're looking for their underwriter or someone else to give them that information on what the requirements are for a well. And the more you know up front and the more questions you ask up front, the better answers you can get up front so you're not blindsided by anything. Because remember, in managing the transaction for any real estate agent, You're only as good as the people you're working with. And if they're not giving you all the information that you need, it's going to come down on you from your service level, whether or not you like it or not. Because especially if you recommended a lender and then all of a sudden an issue comes up with a well that you could have known about up front, that could be a very, very tricky transaction, because it's going to come back to you. You may not get any more referrals from that client. And it could also be something where that loan officer gets in some hot water with the client as well. And it just becomes an ugly transaction. So the idea is to be as proactive as possible with anything that could potentially come up on an FHA transaction. Let's go into a little bit about something that is also on FHA loans that is very unique, and it is very different from lender to lender. And let me read this real quick. There's a couple of questions that came through from Adriana. We do have a strong Spanish speaker on our team, Adriana, to answer your question. And then Letha asked a question. I had an appraiser call home. I'm just going to read this. I had an appraiser call a home I was showing for another agent for chipped paint. They scraped it and painted it. Then because the contractor did not get all the paint chips picked up, and it was before 1972, they called it out again. Yes, that is correct, especially, and that is primarily because the property was built or painted prior to 1978 or built prior to 1978. The reason being is because they're worried that the paint has lead in it. Even though if any properties from 1978 have their original paint on it still, it probably wouldn't look like paint, but the appraisers are under strict requirements from FHA to make sure they call it out and make sure it's all cleaned up. So when this occurs, if in this case, and I will let you know, and she's saying, and your buyers probably have to pay the additional fees for that, was another question on that. There is a fee that every time the appraiser goes out, they charge a trip fee. And it's normally around $100 to $150. If we send an appraiser out the first time and they don't get it done correctly the first time, what I will then do is I go straight to my buyer's agent, Dan Caldwell in this case, and I say, Dan, I go, we just got the inspection back. They did not fix it correctly. In my opinion, we should go back to the seller and make them pay for the second appraisal inspection. So that is in our best interest for twofold, because it carries weight, whether or not we get it or not. We let the buyers know this, because what are we then showing the buyers? That we're trying to watch their bottom line. And number two, we're basically holding the sellers accountable for the repair that they did not do correctly or completely. Because in my world, correctly and completely are one and the same thing when it comes to repair. The problem is that in today's market, sellers will try to do the least amount possible to make it right. Where in reality, by doing it that way, it can sometimes cost more money by not doing it the correct way. Let me see here. There were a couple more questions here.
The rest
Somebody
said, can everyone see anything? It was just all black. And I was like, because your screen was off for a second. So
yeah, my screen was off on it. Yeah, but it's back on now. So this is another important part about road maintenance agreements. So this is a very important note. I'm going to actually give you the guidelines for every single agency in here, but we're going to be specifically about FHA. So FHA does not require a private road maintenance agreement. Let me repeat that again. It does not require a private road maintenance agreement. However, most lenders are going to ask you for a copy of the private road maintenance agreement. And when you can't produce one, a lot of the lenders freak out. They literally freak out. But in reality, they don't have to freak out, because it is the appraiser's job to verify ingress and egress. In English, entry and exit to the property. So if there is a road that is super bad, and I know some in Sahuarita that are really bad, you know, in some of the manufactured areas down there, there's some in Coronas that are really bad. All we basically need to do then is an address via a letter of explanation that the people on the property go down and they clean out the road twice a year. And as long as there's no easements or encroachments against ingress and egress, you have no problems at all getting it done on an FHA loan. So when you have a lender that's asking for a private road maintenance agreement, that's when you push back and saying, I didn't think FHA required a private road maintenance agreement. I thought they just required verification of ingress and egress. On a conventional loan, it is even trickier. Fannie Mae requires a private road maintenance agreement. Freddie Mac does not. So whenever I have a home that's built out in the sticks, I try to go Freddie Mac because then I don't need to ask for a road maintenance agreement. But most lenders, again, these kind of guidelines, the average lender doesn't know them very well. I know that's horrible to say, but if you saw our guidelines are about 1,000 pages between the FHA, VA, and conventional loans. It is a lot for someone to understand and grasp most of the guidelines. But there is no requirement on Freddie Mac for a road maintenance agreement. But again, anytime somebody sees a private road, they just want to go ask for a road maintenance agreement because that's the standard document that we have. On a VA loan, private road maintenance agreements are always required. Always required on a VA loan. However, this is where VA even gets tricky. And we've done this. We probably did it 3 or 4 times last year. And we exercise a lot of caution when we do this because it does carry burden on the veteran that is getting the VA loan on that home. So let's just say we have a street that has 10 homes on it. And this particular veteran is buying a home that is 2 places from the corner. So in other words, not the first home, but the second home. We can actually create a road maintenance agreement to file and record at closing for the owner of that property to maintain the road from the corner to his front door. It's only 2 places, so it may only be like 250 feet of that road that he has to maintain. Now, fast forward and let's look at a different scenario. Say on that 10 home street, and each of those lots is an acre, so it's a big, long street. And they're the 9th home on that street, and it dead ends on the other side. For me to tell a buyer to maintain a road for those 9 other homes could be very costly and very dangerous. So we have to exercise some caution on what we want to do with regard to that. And most of the time, the answer is no, we don't want to do a road maintenance agreement. We want to go have the real estate agents go out to 2 or 3 neighbors, get notarized documents set up and create a road maintenance agreement out there. And the reason why we want to do that is because it makes all those homes available for sale for any transaction. Sometimes the buyers or the sellers that are already living in the home or their neighbors and stuff like that are not willing to do that. In that case, on a VA transaction, we would be dead in the water. There is no way around that going forward. Any questions
out there in those remote areas that we work on? That's some good information.
So other thing to know about FHA loans, this has come up very, very recently, and I'm not sure why this is coming up again. When an FHA appraisal is done on a property, and that property is from a previous client that's not yours, and they did it, but they didn't close on it. They canceled for whatever reason. Their financing fell through, the appraisal came in short, whatever it is. In today's market, we've had 2 or 3 agents try to sidestep the original FHA appraisal. You cannot do that. Once an FHA appraisal is done and logged into FHA for that property, it runs with the property for 6 months. And after 4 months, it is required to be recertified for value. But you don't get to just go order a new appraisal thinking that the market has moved up going, woohoo, I can use the new value. That's not the way it works on FHA. And for that matter, that's the same for VA as well. So you
it's
get
6 months for VA. I'm sorry, Steve, 6 months as well for VA?
Yes, for FHA and VA, and it's a recertification after 4 months that has to be done. So when you get into those transactions, the reason why I bring this up is I'll give you one that we have in process right now. It's not with Dan or Keller, but we have a transaction that is going that was a previous FHA appraisal was done. And the lender is not responding to us very quickly to get the appraisal over to us, as well as what is called the FHA case number to be transferred. So that can cause delays that we're not aware of up front because we don't know whether or not a home is got a previous FHA loan on it or not until we get into the transaction and we order our FHA case number. When it does come up though, we let people know right away, and we try to get with the listing agent to find out who the previous lender was so we can get in touch with them to get that FHA case number and appraisal transferred as soon as possible. Now, the other thing that's come up recently, especially in the market conditions, as prices have gone up recently in the last 6 months, a lot more than normal, is can we get a recertification of value less than 4 months in? The answer is no. Once the appraisal is done, it's good for 4 months regardless. So you can't get around that. Yes.
I have a question about, so if it was previously appraised with an FHA, does the current buyer that is under contract, do they have to pay for that same fee, even though it was already completed?
So most of the time, the lenders are collecting the appraisal from the original buyer. So the answer would be no, there would be no appraisal fee for the new one.
Thank you.
Yep. Now, if they didn't pay for it in the previous transaction, I will let you know that it will be a requirement that it gets paid.
Does that have to be an upfront fee that's collected, or is that something that gets paid at closing?
That gets on most of the transactions. When it's a case number transfer on it, from there, we will collect it up front from the buyer because the previous lender is going to require that we give them payment immediately before they release it.
Cool. On the same
So,
topic of appraisals, how long are they taking?
So
when should they be?
Appraisals are taking about 10 to 15 business days right now. If they're inside town, if they're outskirts of town, 20 business days probably. Benson's 30. To give you an idea, and we love when we, it's very important to know that if you're going out looking at a borrower, say, and they're looking at buying an Oracle, or they're looking at buying in Benson or Wilcox, something way out in the outskirts, it's very important that you check with your lender first on timelines for your offer. Because when you guys write a 30-day offer, we have one that just came in today. Properties in Benson, 30-day escrow. I ordered the appraisal. Guess when the appraisal's due?
Yeah.
3 days after the close of escrow date. So on day one, the good news is I'm going to give everyone advance notice, but it also says one thing, that lender and agent weren't really speaking well together up front. So the agent didn't even think to ask me. She just thought that it was going to be a 10 business day turnaround time regardless, and didn't think that the outskirts of town would take longer, and they definitely do. Other things that come up on an FHA loan, there's a common question on whether or not a termite report is required. Termite is not.
We lost you, Steve. You muted on us.
Termite is not required on an FHA loan. However, if the appraiser calls out that there's massive termite damage and they're calling for a termite inspection, then it becomes a requirement. So if you walk into a home and there's 20 tubes around the house, you can pretty much bet that it's going to get called out, and you're going to want to get a clear termite report, because there's no way you're going to pass that. Because even at that point, they can request it on a conventional loan as well, because that's a safety and habitability issue for the home. Dry rot, deterioration of the home, deferred maintenance, all of those things come into play, and they can definitely ask for that for sure. And they will. We've seen it happen. And the common response back is, I thought they didn't require a termite report on an FHA loan. In theory, they don't, unless the appraiser calls it out because of deferred maintenance issues. All right, so that is about, from a contract perspective, Dan, unless you think of anything else that you've seen come up, that is about the normal nuances that we see on FHA transactions that come through on the contract side. You want me to touch on anything else?
You guys have any questions before we let them go? We kept it a little longer than you wanted to, but lots of great information. Amber's got something.
I just have a question, and you guys may have already gone over it because I came into the meeting late, but my concern is tags, IBIS tags on manufactured homes. And I don't know if it's just FHA specific, but it might be of a manufactured home specific question, but why doesn't the buyer receive those IBITS tags documentation? Because my lender at the time, well, their lender, my buyer's lender, said that if they go to sell the property, the person that buys their property is going to have to order the IBITS tags again and pay another cost. Like, I don't understand that concept.
I don't understand that concept either, Amber, because we give the IBS tag confirmation out when we get them, because that is something that the sellers can use or the buyers can use when they go to sell their property from there. But I will let you know one thing to know. It's good to know what those tags are, but just so you know, from a lending perspective, every time we do not take any documents from the seller with regard to their documents, so we would still order one. It's a fraud issue.
Okay, because I couldn't understand, like, if it's there, why are we not reusing? Like, I get what you're saying though, fraud.
Yep, and it's only because the seller in our transaction is considered non-arm's length and they have a vested interest in getting this done, so we can't trust the documents that they give us.
Okay, thank you.
Yep. Now, with regard to HUD tags, that does bring up something quick just to go over. If the HUD tags are painted over, you can't see the paper and the HUD tags on the manufactured home. There is a section that there is a place we can call and get the IBS tags done. It takes about 2 to 3 business days to get done, but it's normally not an issue. The other thing to know about manufactured homes, just to broach on that, to getting those tags on it, is for them to have those tags and it to be there, also make sure that the property has an affidavit of a fixture. For any FHA loan to be done on it, it does need an FHA affidavit of a fixture on it.
Correct me if I'm wrong, but you don't actually get a tag. You just get a documentation of what the tag is supposed to say, correct?
From IBTS, yes, but the actual tag on the manufactured homes is actually a metal, it's like a brass tag that is actually nailed into the manufactured home.
Correct.
That what happens is when they paint the inside of the home, they paint over them a lot of times.
Correct. And that's what happened to us. I was just wondering how my buyers actually get a physical tag and put it on there.
They don't. They can't. They don't remake the tags, and that's why they have the IBTS look up there, because they don't remake the tags once they're done.
Okay. Thanks for clarifying that, because I struggle with that one.
Yep. No worries. Any other questions at all?
Yeah, Steve, I got a question about, and maybe it's a silly question. The appraisals typically ordered after, inspections have been all agreed upon. I've also heard benefits of ordering it up front in the, like right in the contract stating that. I just wanted to maybe touch on that a little bit, help me out, shine some light on that.
So for us, I'll speak mostly to us, Devlin, and it's really just about market conditions. So for us, we're ordering appraisals on day one on every single transaction. The reason being is because they're taking longer than ever. So I look at it as the area manager for Fairway as a cost of doing business, because I will let you know there are very few cancellations going on right now anyway. And if something came up in the inspection and your inspection was 3 days after the contract, we would still be able to cancel that appraisal before it's even started. So there is not a lot of risk to anyone to actually do that right away. I will let you know that lenders are the biggest issue with that, because a lot of them are like, oh, I don't want to charge my buyer fees if they're not going to close on this property. So it's a little bit of a catch-22, but anyone waiting for the inspection period to be done, say you have a 45-day escrow, okay? If we back out the timeline from that, it's 15 days for the inspection period. That's 10 days for the buyer, 5 days for response, all of those things. Then we've got 10 business days for an appraisal. So you're literally talking about getting the appraisal at like day 35 of the transaction. The closer to the closing you get to that time frame, the more ugly it's going to get. So that is why we are ordering them sooner rather than later, so that if we have value issues, we can deal with them without dealing with everything 2 minutes before closing. And we're at least given a good 10 to 15 days before closing so that we can work on the appraised value and negotiating that, all of those things. So just know this on an FHA loan, that when an appraisal does come in low, that it becomes a negotiation again, and the seller is under no obligation to keep the same terms that they currently have. So as an example, you have a $200,000 purchase price. You're asking for $5,000 in closing costs, and the appraisal came in at $190,000. The seller may agree to reduce the price, but they may say, we're not going to pay closing costs anymore. So closing costs can come from then one of three areas. They can come from the buyer. We can do a combination lender credit, agent credit to keep the deal alive, or we can really bump their rate and try to cover as much as their closing costs on our side as we can. So those are the three options that are normally available to them. I will let you know that in this market, if you get a deal that comes in short and the spread isn't like 20 grand and it's only like $5,000 or $6,000, it is very important that you try to work to keep that transaction together, because the chances of them going to find another home in that same price point with that much luck are very few and far between. So it behooves you to work with the lender to try to negotiate a solution that works for everyone involved, and it makes everything work out for everyone. Because what happens most of the time is you'll get a thing, appraisal came in short. Okay, seller's no longer going to pay for concessions. Okay, we don't have any money, so we're done. That's the normal answer. But in reality, there's still a lot of work to be done to figure out a way if we can finagle it. It's like, okay, we know the listing agent's going to be able to sell that home in a heartbeat, but you have a $200,000 home, and it's either you get commission on this or you're going to go out for another 3 or 4 months and not. If we can put in 3,000 and you guys can put in 1,000 of your commission to offset it and keep the deal alive, it may make better sense than just letting the deal walk away. So just remember, it's not only a negotiation between seller and buyer, but it could get the agents involved. It could get the lender involved, all of those things to come up with solutions for that. Basically, don't give up on the transaction if something comes in low or changes or, repairs. Like the other thing that we see is appraisal comes in low, they agree to pay concessions, but they will no longer do any repairs. That's totally fine as long as the buyer is okay with it. As long as we make sure that they're aware that they're going to have to do those repairs on their own post haste after closing, and to make sure they have the ability to do it. We don't want to put them in harm's way, but it is something that is coming up more and more. I probably had 3 last week. Appraisals came in slightly short, not major, but the seller's like, I'm not doing any repairs anymore. Take it or leave it. We'll go sell it to someone else. So, and they negotiated, I think one was like $3,500 in repairs. The other one was like $8,000 in repairs. So very important to know that, guys, in your negotiation process, that you do have opportunities to negotiate with more than just the seller and the buyer, that agents, lenders can all get involved in part of the negotiation process. So there was a question that came up from Laura about some FHA repairs being mandatory. Any repair that is called out on an appraisal, whether or not it's conventional, FHA, or VA, is always considered mandatory. I'm mostly speaking about vendor negotiated repairs that didn't show up on the FHA appraisal, that you can, that we don't see or have any knowledge about. Those are the things that normally get done. Like, for example, on a pitched roof, they may have an $8,000 roof repair that they were going to negotiate at closing to be paid, but they decided they weren't going to do that anymore because the appraisal came in as is, it just came in short. Any other questions on that, guys?
That looks like everything on there, Dad.
All right, guys. Any other questions? Obviously, you can either email Dan or myself and let us know. But that is pretty much it. Or if you have any questions that come up after this with Dan or anything like that, you can shoot them to me and I'll get answers back to you guys.
So, as always, guys, thank you so much, Steve, for jumping in and help us with our Mortgage Mondays. We'll see Steve on the 3rd Monday of every month. So look out for that. Next week, we're going to talk more about that. But these are some impactful things that you can utilize to give yourself the edge in this buyer's market especially that last part where he says you got a deal that's falling apart over the appraisal and there's closing costs involved and they want to back it out. You need to work together. We talk about the win-win situation. I know that Steve, he doesn't want to give away money like lenders talk about, partnering with them, but keeping a deal alive is servicing your clients in the highest and best of your interests. Especially if you already got the yes, you're already on contract, you already gone through all the inspections. Why would you jeopardize their home stake for a couple $1,000s? So if all parties involved get along, we can make it happen. We can move mountains if we're all working together. So it's important to have yourself a strong lending partner. I do have Steve's contact information. If you guys have questions, want to email him, please send me a message. I'll put the information out there. Adriana, again, he does have a strong Spanish speaker. This is not a plug for his business to grow his business. Trust me, he doesn't need it. The dude's got his movement in motion now. I just want to tell you that I partner with the people I partner with because they give the service I expect, and they're willing to do the things that others are not willing to do to make sure that our clients are taken care of. So all this information is amazing. It's great information. Put it to work. I hope you guys got a better understanding of how the FHA models work and how that can help you win business in the future, as well as help protect your sellers when you have listings. So like Letha said, they had to come out 3 times for the appraisal because they didn't pick up some paint chips. Now you know, right? If that alone saved you from having to pay a $150 trip fee, it was worth your time invested. For those of you who are joining us on Family Reunion, thank you so much for being part of that community. We'll love seeing you on those calls starting tomorrow. At the market centers at 9 a.m., we're doing the vision speech here at all the market centers. Colleen is bringing us some breakfast. So you guys can have some snacks. We start at 8 a.m., calls at 9 to 10:45 or so. Would love to see you guys at the market center. I'll be at the east or the north location. Jay will be at the east. And if you guys have any questions between now and then, our call question and answer time just started. So I'm going to back out of this call, bring all your questions over to the Q&A. We'll see you then. Thanks again, Steve.
All right, guys, have a great day.